Thank you so much, Leonard. Welcome to Forex Pays presents 4 Steps to Avoiding a Choppy Market. And I'm your presenter, Greg McLeod. And it's great to be with you here on this evening in Europe. And we're going to talk about how to avoid a choppy market. Now, how many of you have been in a market where it's not going anywhere, and the only thing that's going somewhere is the money in your account? Because you get long, you get stopped out because it goes down. Then you get short, and then it goes up, and then you get stopped out again. Have you ever been stopped out repeatedly in a market? And if you hit, and I'm sure many of us have, and we're going to find out 4 ways to avoid the choppy market, the dreaded dun 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 choppy market. Okay, and let's go ahead before we get started. Make sure to do a quick sound check, video check. You can hear me. If you can hear me, please type the letter Y in the chat box. Let me know that I'm coming through loud and clear. And we'll go ahead and get started. Okay, great. Thank you so much. All right, so let's get into it. I'm going to first direct your attention to the risk disclosure on your screen. Should be the next thing coming up. Ram, nice to see you. And there are a lot of risks associated with foreign exchange trading, so I'll give you a couple minutes to go ahead and read our risk disclosure, and then we'll go ahead and proceed. For those of you who don't know me, my name is Greg McLeod. I am a trader and trader's coach, and I'm a 20-year veteran. I've been trading for 20 years, and it's my great pleasure to be able to share with you my expertise, my knowledge with you to help you avoid the choppy market and help you trade better. And I've worked behind the scenes at one of the largest Forex brokers in the world for 8 years. And so I have a bird's eye view of what's going on. Okay, so I have a passion to help traders become professional traders, and that inspired me to launch the forexpaydays.com website. And it's a website devoted to helping traders, and it's a wonderful community of traders. So hopefully we'll be able to see you in there, and you'll be able to be part of all the action, and especially part of our Pip and Run community. Okay, so let's look at it's 5 steps. I found one additional step as I was doing my research and putting everything together for this presentation. I came up with 5 steps, so you get an extra step and no extra charge. So we always check the economic calendar. That's what we want to do, one of the 5 steps. There's 5 steps to, if you have a plan of approaching the market, you'll find that you can avoid being caught in the whipsaw. So one of the first 5 steps we're going to look at is checking the economic calendar. 2, examine current price action. 3, check time of day. 4, check www.myforexheatmap.com. And 5, use volatility indicators. So if you can use these 5 steps, remember at the end of this session, at the end of this presentation, you should know the 5 steps to avoiding the choppy market, and you should be able to avoid the choppy market. Okay, so let's go into the first one. Okay, but before we get started, I want to let's see if we can drink this up a little bit. Okay, it says traders, we live for the trading for trend trading. For a trending market. Higher swing highs and higher swing lows. That's what we like to see, like this nice move on the dollar Norwegian kroner. We have oil dropping, and then we have this thing popping, right? Nice higher highs and higher lows. That's the definition of a trend. But you know what? Only the market only trends like this 20% of the time. Okay. So what happens the rest of the other 80% of the time? Well, I'll give you a little bit of an example, see what's going on here. All right. And if you can see what's going on. Well, the term choppy market comes from the term with the waves. Chop, chop. And if you're out there, you're not going anywhere. You're not going north. You're not going south. You're just caught in a choppy market. Okay? So that's where we get the word choppy from the choppy waters to choppy seas. And so we want to avoid the choppy seas. We want to sail in the smooth waters. Boy, this is getting me cold and wet just thinking about this. I'm sure it's probably outside of Joyce's bedroom. She can watch the waves from her place in Florida. Let's go ahead and move on to the next slide. And yeah, my pleasure. It was Joyce's idea to do this choppy market webinar. I think it's going to help a lot of people out. And let's go to our next slide. Okay, hopefully we'll takes a lot of bandwidth there. Hopefully, but so as much as we would like to trade our favorite currency pair or CFD every day after we have made up nice gain, you've done it before. You got the euro, you got the euro's number. You're hitting it for 10 pips, you're hitting it for 13, you're hitting it for 20, and you're just hitting it. And the next day, I'm gonna do it again, right? And so maybe we don't want to do this. Maybe we're trading gold. We're getting the spike out, we're buying the breakout on gold, and we have a trailing stop, and we do it repeatedly. But then the truth is these instruments can take back all of your hard-earned gains in what is called a choppy market 80% of the time. 80% of the time, markets move in a sideways consolidation, much like you see in this chart here. Big range, a lot of chop, a little breakout, but a lot of chop. And this is where you lose your money when you're like getting long here, pulls back, you get stopped out, and it goes up, and then you buy the break and you get stopped out. And that's no fun. I'm sure you have the hat, the t-shirt, the cap, and the mug that goes with this ride, right? And so we want to avoid that. So what we can do is check our calendar. Okay, that's one thing we can do for especially for looking for things like holidays. Okay, if we have holidays like a bank holiday in the UK, a holiday in China like a Golden Week. They have a week-long holiday where liquidity just dries up and prices without liquidity, without people participating in the market doesn't go anywhere. So you're just kind of sitting around and like going, they're on vacation, they're having a good time, lighting fireworks or barbecuing something, or just chilling out on the beach, and you're sitting at your computer going, okay, Euro, it's time to make some money. It's like, no, it's not going to happen. Okay, I was a teacher for years. I taught in public school system, and we would always get summers off, or we'll get one of the holidays off, right? Oh, I can trade the market because there's a bank holiday or there's some type of holiday. And you get in there, and it's like, whoa, I'm off, but the rest of the world is off too, and so the market doesn't move. The market is choppy, and I wind up getting chopped up and losing money, because I have the day off doesn't mean that the rest of the world is trading when I'm off. In fact, probably if I'm off, the rest of the world is off too. And so you want to check for holidays in the calendar. A Forex Factory calendar has that. If you go to forexpaydays.com under tools, we also have a calendar there as well. Another thing that can make a choppy market, if we have a no news day. Typically we have 8:30 releases of U.S. economic news and at 10 o'clock. And if you don't see an economic announcement at 8:30 and 10, we might, the pairs that are highly correlated to the U.S. market open, like the euro versus U.S. dollar, pound versus U.S. dollar, things with dollars in them may only range, okay? Or let's say we have non-farm payroll, major news announcement on a Friday, we might see certain pairs just move sideways going into that announcement, okay? So we might even have a ranging market going through Asia or the European session until the New York session opens when that news announcement actually opens, especially if it's highly talked about and highly anticipated. So you want to use this calendar as a way of navigating your way through the choppy market. If we see red folders, high impact news, chances are we're going to have a trending market. If we have lots of minor announcements, like natural gas releases or oil, oil survey or something very, that Forex traders are not going to pay attention to, then there's probably not a lot of catalyst to spark a move in a currency pair. So you want to religiously check your calendar, just like when you cross the street, you look both ways before you cross the street. Well, nowadays they don't. I think people just run across the street when the light's red, right? Um, so you want to be able to look both ways. Look left, look right, then look left again, then walk across the street. Well, before you place a trade, you want to pull up your economic calendar, take a look, and see where the party is on these various currency pairs or the various currencies or countries. And if we see maybe the GBP or UK data, then the British pound pairs may be in play. And so you may be trading Aussie dollar is not going anywhere. Why? Maybe it's a holiday. Maybe they had a big move overnight, and now you're stuck in Aussie dollar. You're like going, I need a faster horse. You need to go where the party is. The party here, 830 PPI. Well, usually the euro and the dollar CAD, those pairs are going to be pretty active. Pound versus US dollar are going to be active during this time period because they are like the anti-dollar. Good US news, then the euro drops. Bad US news, the US dollar rises and the euro drops. So you have this yin and yang going on, and especially when you have big red folders or red boxes here, high impact news. Low impact news is going to be choppy. If there's no news at all or a holiday, choppy too. Okay, let's go to the next item here. For us, again, we're looking at 5 steps of choppy market. Now, price action. You want to check price action. Price is indicator number 1. Okay, of all the indicators in the world, if you had one indicator to trade, price would be it. Okay, and you have to realize that the market expands and contracts like breathing. Inhale, exhale. Inhale, exhale. Oh, sorry about the onions, ladies and gentlemen. But you can see this is the dollar yen. Look at this: December, February, March, April, May, June, July. I love my calendar, girl. Yeah, yeah, yeah. Okay, but we don't like this kind of market. We're not going anywhere. And then we get a breakout. And then we start moving to higher highs and higher swing lows, like this picture. You think of a better comparison is to a runner who has run at top speed for a long time but expends all of her energy and has to walk or rest for a period before running again. And if you look back farther on the dollar yen, you can see that we had a massive uptrend leading into this consolidation. Again, we're talking about steps of avoid a choppy market. I'm sorry, I've got the. Let's see if we can maybe let me cut some bandwidth down here. I've got this YouTube channel open. I could probably close some things down, and maybe that would help. We can close some tabs. Holger, good on your side? Okay, I'm just going to close some tabs up, and hopefully we will have more bandwidth to work with. Or no, oh, you're talking about me. You're talking about Joyce. No. Okay. All right. Let's get back to our presentation. All right. All right. So walking and running. Right here, price is walking. It's choppy. Now it's running. Okay. So we can use prior price trends to anticipate a period of ranging consolidation to come. So we can probably figure that after this big run, that sometime down the line we're going to have a period of consolidation in dollar yen. And they say the wider the race, the higher the wider the base, the higher the race. So we have this base being built, chop chop, and we can find another pair to trade. Now we can use this choppy consolidation to anticipate the resumption of a trend, and then we can use a trend to anticipate that, hey, if this thing stops making higher highs and higher lows and starts moving sideways, then it could lead to a decline. And we probably a good example is a weekly Aussie dollar where we moved in consolidation. Okay. And if you're looking at like Elliott wave patterns too, and I'm going to show you some examples. I'm going to pull up the trading platform. We're actually going to look at some real-time examples, and I'll show you. In the Elliott wave, waves 2 and 4 are going to be choppy. Okay, so after a big move in price, a big wave 3, that's our big move. We'll have a choppy 4, right? The consolidation before we resume the breakout to a 5th wave. Now, check time of day. That's our next thing we want to do. We want to. Sometimes the day are better than other times of the day. Sometimes the day, certain parts of the day are really rocking. I mean, boom, we can have some big movements in the currencies. Why? There could be an overlap. There's a periods of time. Here is the Asia session in blue, and this is in GMT, and there's a London session in dark blue. New York session is in red. Now, the Asia-London overlap between 8 GMT and 9 GMT is in green. And you can subtract 5 hours off Eastern time to figure that out. That the three between 3 yeah, go ahead and add that. Yeah, 3 and 4. So we have a little overlap there, and that's where we'll find some volume there. Now, the best trading times are going to be this overlap between London and New York. That's where most of the Forex volume happens, between 13 GMT and 17 GMT. We're going to have this green represents the overlap, and that's the sweet spot. Okay, just like in a tennis racket or a golf club, there's a certain sweet spot where if you hit the ball there, that's where you're going to get the most bang for your buck. Okay, so if you're trading on off times, now given sometimes you'll find prices moving pretty good at these odd times, but for the most part, where we have the overlap of two major trading sessions, like the New York and London or Asia and London, you're going to find more liquidity, more players on the field. You ever try to play baseball with two people? Doesn't really work. You have to have 9 players on one side and one, or it's a difficult game to play with without enough players. And the market's the same way. You want to have enough players in the market creating that volume. They're putting those levels in there. Either they're buyers creating support or sellers creating resistance. So we want to check the time of day, and you want to be able to close your positions and say, you know what, maybe around noon U.S. time, I'm out. Okay, London is closed. The DAX Germany is closed, and so we can see that we can have more success if we trade when everyone else has. Okay. Now this is going to be recorded. So I'm recording it right now, and so I'll upload that to YouTube, and right after we're done. So if the sound isn't coming through, I'm sure that it's going to be good on this end. So I apologize for the problem, technical difficulties. Now, after you check time of day, so you can see here in this graph, you can see the dollar yen. And see, in the Tokyo session too, you also want to trade currencies where the banks are open. Okay. Now, since during the Tokyo session, the yen is heavily traded. 78% of all transactions during Tokyo is the dollar yen. 15% the euro, and the euro yen's got about 5%. The pound versus U.S. dollar, sometimes it runs. It's a weird one. Sometimes it runs during Tokyo, but sometimes it flatlines. Okay, it's probably the closest thing to it being closed because maybe there's not a lot of trade going on, but just the cable is not going to move a whole lot during Tokyo. So we want to trade currencies during times where there's the market, the corresponding market of that country is open. So here's London, and then we can see the euro is going to be 39%. A majority of the trade is going to be in the euro. That's a single unit representing the European bloc. Then cable, 23%, and then dollar yen drops down to 17%. A smaller portion, almost an inverse during this London session. And then dollar CAD and Aussie dollar kick in a little bit too. So this is what we're looking at. So we want to trade currencies, picking the right currency too. If you're picking some other currency pair, maybe like the Swedish kroner, the euro Swedish kroner, and you're trading during Tokyo and it's not moving, don't complain because it's not going to move. Both money centers are closed. Okay. So let's go ahead and take a look at. I want to take a look at some charts here, and I want to bring up. This is the end of our slide presentation. Again, we're talking about trading the choppy markets, and I want to go to our next slide of what we're looking at. And actually, let me go ahead and bring up the C-Trader platform. And this is a Trader's Way C-Trader platform. And remember, you get to you know, by opening an account with CTrader, you get the education that we're working with, our educational partners with Traders Way, and so that's a good thing to think about. Okay, and we'll bring up our platform right here. All right, here's our trading platform. I'm going to have to size it down a little bit so it will fit in our recording box. So there we go. There's our recording box, and we need to shrink it just a little bit so we can see some more things here. Okay. Again, this is a free informational webinar, and this is about the quality of webinars and course materials. Just giving you guys a welcome, a howdy do, to help traders become better traders. That's our commitment. And hopefully you'll join our free Forex community. Holger's going to look for a sign up part where you guys can sign up if you're brand new, and you'll say, hey, what's this all about? Well, then join our community. We got some great traders in our room. It's free to be in our chat room, and you can talk with me and other traders as well. Okay, so we can look at a couple of things. We can look at indicators to actually help us in this market. Now, I'm going to put up a template for you that I have built already. I hope. Is it volatility? I hope it is. Maybe. Maybe it's not. Okay. Let's see. And okay, it's loading. It's loading. But you can use indicators, and there's a couple of indicators, 3 indicators you can use to help you determine if you're in a choppy market or not. And this is not. Okay, Bollinger Band is one. And there is this Bollinger Band and we can see where our Bollinger Bands show us that we're in a choppy market. When the Bollinger Bands are flat and moving sideways, we're in a choppy market. You know, this horizontal. When those bands start to expand, it shows us that we're in a rising uptrend, and price starts to ride either in a downtrend, maybe riding the top of an uptrend, riding the top of the Bollinger Band. That shows us that we're coming out of a market, a ranging market. Or if the band is expanding and price is moving down and hugging that lower band, we're in a downtrend. I can probably show you the Aussie dollar, and that would show you on this daily chart how we went through this expansion in this the Bollinger Band expansion. So Bollinger Bands is one way, and here they are. Here we had compression, sideways consolidation from April to August. We could not get out of it. Could not get out of its way. You can see the range, and you can see how these Bollinger Bands are kind of narrow. But when they started to expand, we were in a trending market, and just selling rallies, and we had a period of consolidation where the bands narrowed, and then they expanded again. And so they actually will expand. We'll see like penetration of the band. That'll be like the first warning, and then the bands will start to expand. And that's one way of using Bollinger Bands to determine if we're in a choppy or ranging market. And we can also go down to lower time frame charts too. Maybe go down to a 1-hour chart, and if you're a day trader scalper, you can see something like that. Like right now, the bands are moving sideways, and we are not. But look, looks like we're breaking down the low, and where the bands are expanding. So maybe the downtrend is starting as this band is being blown out here. So we may see maybe some lower moves down in Aussie dollar. Okay, so we did have some sideways move, and now the bands are widening out. See how the band's pointing down? It's kind of giving you a clue. Hey, I think we're going to go down. Okay, so that is one way. And let me go ahead and my color change here, and I'll show you the other way. And okay, oh yeah, I have to go this way. I have to go to color options, and then go to bright. And there we go, nice and bright. Probably shows up a little bit better there. Okay, I'm going to go ahead and let's put up another chart here, and let's put up a good looking one. Let's look at pound versus US dollar. Let's look at cable. And I'm going to show you another way of determining whether a market is choppy or not. And that's with an old friend, an old tool, one that you've all been familiar with, that you probably never knew that you never really thought about using it in this way. And I'm going to show you how to do that as soon as I just get rid of some of this extra extraneous stuff here, the grids and the lines and things. I can clean it up a little bit. Okay, as moving average, we can go really just go here, go to symbol, and go to, go to indicator, and then you can do this on any chart package, and we can actually go to trend and actually go maybe put an exponential moving average. But I'm going to put 3 exponential moving averages, and this is what I do during the Pip and Run, my live trading show that I have every morning, 5:30 a.m. Eastern time to 7:30 a.m. Eastern time. And what I do is I'll go ahead and place a green on the high, a green 100 the moving average on the high. I'll go ahead and do that and click OK. And then we'll put another one on there. We'll go to indicators. We'll go to, I'm sorry for not having this done previously, but let's go ahead and do it again. But I'll show you. It shows you how to build it. And again, another 100 period moving average. This time on the close, and maybe I'll make that one a little bit thicker with 2 and make this like maybe a yellow color or gold color, so it'll show up. Okay, and then I'll go ahead and place a third moving average, an exponential moving average. It's also 100. All 3 values are 100. And you've probably seen this before. Some people use 34 or 50, but I use I'll put 100 on there, and we'll click OK. So now that's the wrong one. Okay, let's go ahead and go to my indicators and my object list. Okay, so I've got that one should be on. We'll go ahead and remove that one. How about that? Okay. The low, we want it on the low. That's right. So let me go ahead and go to indicators. One more time here. One more time. We're going to add the trend. We'll go to exponential moving average, and we'll put the 100 on the low. On the low. And make that red and thicken that up a little bit. Okay. There we go. That's our 3. So then what we can look at is if price is, if price is just chopping around in there in this moving average, okay, we're not, or we have twisting moving averages, like if we have our 12, 13, and 21, our Fibbo moving averages, kind of twisting around, that's going to give us a ranging move. Now you can see here, let's go to a daily chart. Maybe back it out. Maybe let's go out to our daily chart. Now, if we have our moving average bands and prices are just hugging around those moving averages and not really doing anything, I mean, here we were moving sideways for a bit. It was kind of choppy in there. Finally, we got clear. We want to be either clearly above it or clearly below it. But if we're stuck in the middle, we don't want to be in such a trade. Now that we have a prolonged period where we're stuck in there, let's move to a 4-hour chart, and that's the dealer chart. So I kind of would like to look something like that. Like that. Right now, we've been in chop for a bit. We rallied into this area. This is the pound versus U.S. dollar, and I remember trading this. And I actually was Holger and I were actually online trading it together. And I said we get a breakout, and then right in here we were at that 57.00, and we weren't going anywhere. Finally got the spike that I was looking for, but I was already whipsawed out of the market there. But we get to the price target that I had from Pip and Run earlier, and then we drop. But we're stuck in here, and this is each candle represents 4 hours of price action. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. That's 144 hours of nada. Nothing going on. We haven't broke to new highs. We haven't broke to new lows. We're stuck. So this would be a pair that I would take. You know what? I don't want to look at you because you're not going anywhere. So we would like take this off our list and move on to something else. Why? Because this isn't resolved yet. And I would look at, maybe I would have an alarm. Okay, 57, 55 breaks. I might take a look at it. Or if we broke below 56, 52, I'll take a look at it. Look at that. It's not going anywhere. This is chop. And so when you pull up your charts and you see that, oh, they're all 100. Hi, Imran from Pakistan. How you doing? Salam. Okay, yes, each one is 100. It's a 100 exponential moving average on the high, 100 exponential moving average on the close, and 100 exponential moving average on the low. So that's so we use as moving averages. Now let me go show you another tool you can use. Now you could use the moving average bands. You can use 3 different moving average. Like I use a 13, a 21, and 55. You're welcome, Imran. And you can have some moving averages that way. Let's okay, this is my tick chart. I don't want. It takes a long time for those to load. We can stay away from that one. Let me go ahead and pull up another chart for you. And let's take a look at dollar CAD. Dollar CAD has been on a tear. Dollar strength, and you can see we had this kind of a sideways move, and we finally broke. But let me go ahead and just get rid of all of our little deals here. I know I created a wonderful. I get rid of bid and ask line. Okay, so here we go. We have this. Now the next thing we can use is our ADX DMI indicator, and I believe I shared a video with Joyce on that indicator, and I'll show you how to use this. Not very many people talk about that indicator, and it's so it's our directional. See, we have our actually trend that's under ADX, directional movement system. It composed of 3 elements: an ADX, which basically tells you if whether we're in a strong or weak trend. Okay, so it really doesn't matter what direction it goes in. It tells you if the trend is strong or strongly trending, or if you're going to get into maybe a chop zone. DI plus tells us the direction, and DI minus tells us if it's an up direction, DI plus is above, it's green. DI minus directional minus means if the red line is above, it means that we're downtrending. So let me go ahead and we use a standard 14 period. Again, ADX. The one we're going to really pay attention to is the ADX. We probably don't really need the DI plus DI minus because it kind of chops around a little bit, but this is what it looks like. Okay, and what you want to see is a rising. The blue line is the ADX. Okay. And when the ADX is above 30, then we start moving into a trending market. Notice how the blue line, as it starts to get down in the 20s, we're in a range. And so we don't necessarily want to initiate trades when we have this coiling ADX in that 20 range. We want to see it start to angle up, and that gives us that we're in a trend. Now, it can angle up even in a downtrend. Okay, so all it tells us is that the trend is strong. If it's between, if it's below 20, 25 and below, then it's considered ranging. And if it starts to move up above about the 35 area, then we are, like right now is at 34. Okay, so it's moving out, and you can see that we just moved outside of a pretty hefty range just recently here. Just got a breakout of a range, and we can see how when this blue line starts to take off, okay, and we moved out above 20, 25, 30, above 35, then all of a sudden, we've got big moves, okay, in the market up, and big moves down, and big moves up. Now remember, this just tells us strength. As long as we stay, when we're up here, we avoid the range. In fact, we did pull down into a little bowl, but still ADX stayed pretty high. Now we can take a look at a pair that like Euro Swiss. Now that's like the typical. That thing has been ranging, or the Hong Kong dollar. Okay, now look at that. That is ugly. If you want to avoid chop, you want to avoid that. Okay, now look at the move. Look at ADX. It's below 20, and we're not moving new highs. No new highs, no new lows. Lots of overlapping waves, and that is showing us that we probably don't want to be in this trade. Now, once we got ADX moving up above the 20 area, moving into 30, that's when we start seeing a breakout. And so we have a little bit of maybe confirmation. We got that green DMI right here, breaking up north. Okay, green above red, buy, and then ADX trending above 30, above 25. Then we are looking at this continued move. And even when it dropped, ADX is still high. Why? Because it's still trending. Now it's trending down. It would trend it up, and it's trending down. Now this one it drops, and we can probably expect it to maybe continue dropping. Now, however, if ADX starts moving down into this 20 area, 25, and we might see this drop back into a range and stop moving. So that ADX is a way to help us gauge which currencies are trending and which ones are not. We can quickly go through our scroll through our different currency pairs. Look at dollar Swiss, and we can look at our chart, look at our time frame, and we can see, well, look, this is moving down. This is ADX, and well, it depends, what type of trader you are. If you are a swing trader, what are you doing on the 5-minute? And if you are a 5-minute trader, why are you looking at a daily chart? Okay, so basically you look at your trigger time frame. And that's a good question, Holger. You want to because price exists on different in different trends in different time frames. Okay, if you drop down to a 3-minute chart, that Euro Swiss is taken off, right? But if you drop that back out to like a 4-hour chart, it's not moving. So you have to stay on the time frame where you trade. Wherever you trade, that's where you want to take your signals and indicators from. So let's go ahead, and so we've got this good question. We looked at the ADX, and it's a good way. You can clean this up a bit. You can clean this up where you can put it on here and not have the red and green lines on there, and just have the ADX line. In fact, let's go ahead and do that. I'm going to get rid of this. I'm going to put a fresh ADX on here. Hey, Michelle. Yeah, it's a hard, the time frame discrepancy. That is a wonderful. Alan Farley wrote about that in his book, and I've got his book, but he really drills home on that, where people are looking at uptrends on 5-minute, but it's a downtrend in an hour, and then all of that 5-minute trend is a counter trend move, and the hour trend hits them in the back of the head, and they get knocked unconscious or something, because they just miss it. So it's very important to look at I look at 5 periods of trend from where I am. So if I'm looking at a 5, my trend control is my 30. My GPS is my 30. I'm going to look at my 30 to determine the direction. I'm going to take my signals off the 5. So I'm looking at ADX on a 30-minute or 1-hour chart. Okay, that's what's gonna help me. Let me go back to our trending one more time. Let me go to volatility, oscillators, and we lost it. Directional movement. It's under directional movement system, but we don't have to have the DI plus and minus. There's a lot of extra noise. If you just want to keep it simple, just have the ADX on there, and that way you can just say, okay, you don't want to have a. So there you go, and you can see when we were, and we don't have threshold lines here. We can draw those in, and you can say, okay, maybe that 30 is a pretty good threshold. Now you can see that when we're down there, we're chopping. When we break out, we're moving higher, and we're moving. We're actually breaking out and moving. Okay. Okay, so let's go ahead and so we looked at the ADX and looking at indicators. We looked at moving averages, and I want to do the moving average thing. We looked at the band moving average, but I want to show you the let's see if we, and my templates are missing. Okay, no worries. Let's go ahead and I'm going to add an indicator. I'm going to add my Trinity indicators with this the three moving averages, and again I use a 13 for the and I'll make that green representing the fast traders in the market. Okay, and I'll make that thicker so you can see that, and then I'll go ahead and add another moving average. We'll add we'll go ahead and add the next indicator. We'll go ahead and add is the 21 period moving average. Okay, exponential moving average. Put that 21, and I'll make that a yellow because I think in terms of a stoplight. You know, red light go, green light. Oh, red light go, red light stop, green light go, yellow gun it, go for it. Okay. Anyway, that's how it works here in the U.S. No one slows down at the yellow light. Okay. Let's go ahead and add another indicator. I'm going to add a 55 moving average, exponential moving average, and this is probably a very graphic, easy way of determining if you're in a chop. You know, I mean, my 12-year-old daughter can tell me, "Hey, Daddy, you know, oh, what are you doing? Oh, I'm getting long. Well, it does not look like it's going anywhere." It's like, oh, really? It's like, you know, if you have little small children, they can tell you bulls and bears, but you can see where we get into when we have the moving averages spreading apart in an order, the 13 followed by the 21 and 55, they spread out, and that we have a nice trend. When they kind of twist around, that is when we're in chop, and we want to avoid the chop and find something else. Just move on. You know, it's like speed dating. You know, it's like, hey, oh, you pick your nose. Oh, find the next one. Next date, please. Okay. So there you go. So you can see the areas of maybe chop and consolidation with the moving averages, and when they spread out, it tells you, hey, we move from. Remember we talked about earlier. We move from the market is breathing, it's consolidating, it's breathing in, inhaling, exhaling, inhaling, exhaling, inhaling, exhaling. Now, a way that I have done for years. I'm going to show you the last way of finding and identifying a choppy market. And if you can identify a choppy market, you can avoid you can find the trending market. If you can avoid the choppy market, it means you're spending less time getting chopped up and giving the money back to the market, and have capital ready. Because what happens is you get chopped and finally it breaks out, but you've lost all your money getting in and out of here, and then now you only have a little bit of money, and then we get to the top here, you break even. Hey, you know, instead of really reaping the rewards of the trend that you found. But a tool that I'm using, that I've been using a form of the tool for a long time, and not the guy in the star thing, but go to myforexheatmap.com. Let me take you to our website, forexpaydays.com, and let's see if we I got too many W's, and let's see if we can get it to load up. You're losing a lot of bandwidth here. Okay, so this is our website. And get a little, see if we can, things are kind of a little slow here. Okay. Internet connection, I guess, is the afternoon. Okay. So let's just go to the welcome page here. This is our my website, forexpaydays.com. We have a number of courses and videos and different tools that can really help you out in your trading. I also give a free coaching session, free 30-minute coaching session for those who sign up. Just click that button in there, and I'll talk to you for 30 minutes and help you find out what your goals are, see where your trading is, and how we can improve your trading. Give you some tips, some tricks, some hints to get you on your way. And I've helped Tracy Anderson, a number of people turn their trading around. I was a featured in Top Trader, so I can help you as well. But what I want to show you is the My Forex Heatmap, and this is an arrangement of currencies by percentage change. Okay, and this kind of helps you to stay out of the market. What you're doing here is you got, and Joyce says Greg is telling the truth. He never stays on time, always more than he says. Yeah, there you go. Can you give me a brief minute on the heat map? Yeah, we got the heat map, and here is green. We have our trending pairs are in green. Okay, they're uptrending. You look at basically on an hour chart, and you'll find out that the pairs that are at the top of the heat map are trending higher. Now, and usually the ones that are in the lower quartile in red are downtrending, while the yellow just means that there was a change in price, but not enough to actually move it up the spot. Now these are dynamically moving. They are moving up and down throughout the they might be traveling. We might something move from the last spot up to the top spot. Now that tells us that it's gaining some strength. We may see something in the top spot actually start to drop. So this is one way we can get 70 currency pairs, indices, and metals in one shot, and you're able to see what's moving. Now look at this gray area. I talked about the green uptrending area. I talked about the red downtrending area, but this gray area is where, oh look, Euro Swiss, there's our old friend there. There's some pairs that never leave this, like the Hong Kong dollar or the Bund. They don't, but some pairs come in here, like Pound Kiwi, may spend some time here and then break out. Now you can try this for $1. You can just click the subscribe button, and you can try this for 30 days for $1. If you don't love it, hey, you can just end your subscription. If you're a member already, you can go ahead and click members enter. You click in here, and it will prompt you to type in your username and password, which is your email address. And let me go ahead and log in, and make sure I put my email address in here. And feel free, if you see my email address, you can email me. Email me at greg@forexpaydays.com, and we can get you started here. So there you go. This is it. This is the Forex heat map. Now I'm going to tell a little story about this. I wanted to when I worked for the big box brokerage, I said, hey, you guys, this will help traders, let them know where pairs are trading and help them maybe make money. And they said, oh, that's a bad idea, Greg. It's like, so consequently for 6 years, my idea was shelved. So I decided, when I get on my own, first thing I'm going to do is get my heat map back up. Create it, hire some programmers, and get it done. And so here we go. We have dollar yen at the top spot, and that's up 1.6%. Man, that thing turned around this morning. We were shorting that baby, right? And we're at the bottom, and it broke trend line, shot up, and now it's in the top spot. But look, you can see what's going on. Dollar Norwegian kroner, that was a chart that I showed you that was trending. CAD yen, and our Nikkei 225 up 2.14%. Now, all you gotta do is look at these smaller numbers, and those are the percent change. And you probably, a lot of times, we don't see numbers very well when we get older, or we just don't. Even younger people don't look at numbers. But look at these numbers. When you've got something that's up 1.83%, that's an uptrend. A 1%, almost 2% move in a currency pair is huge. Usually, and so anything that's above like 0.25% is going to be in the green, like 0.4%. But look, 0% move on the Hong Kong dollar, negative 0.2 on the Italian, the FTSE MIB, the euro, the Danish kroner, negative 0.3. It's not moving. That's chop. Anytime you have small percentage changes, you're going to have a period of chop. Now, this could break out. Now, one day, I know I think Dave Ihorn or something said that the Hong Kong dollar was going to break out and the peg was going to break, but we have not seen that. But you know, pairs with small percentage changes, I might not necessarily want to trade those. Now, I might not necessarily want to trade the ones that are extremely have moved already at 1.83. We may be at a top. Okay, we might do some mean reversion, but at least I know this is active, and I have at least a fighting chance that hey, if I pick one of the top 6, top 5, I'm going to be in good shape for trading. In fact, we looked at dollar yen, Nikkei 225. What else is that? Kiwi dollar, and we can pull up charts on those, and we can see that the charts are moving. So if you already know, I looked at 6 charts. I just look at 6 tiles, and I know what's in an uptrend, and I can go down here, down to the bottom, and I can tell what has actually is dropping or trending down. Whoa, Euro Kiwi, Euro Pound, Aussie Kiwi. Kiwi seems to be pretty strong. And you can see the pairs. I mean, if Aussie Kiwi and Euro Kiwi are down here, we must have Kiwi dollar somewhere up there somewhere. And we have the pound down as well down in this area in the basement. Okay, but 0.59%. Let's look at. I'm going to take a look at Aussie Kiwi. It's down there along with the Aussie dollar, and then let's take a look at Euro Kiwi, and then we can just take a quick look. And then we've already have basically now we know where our trends are. Okay, let's go ahead and take a look. Go to symbol, and let's move to the Aussie Kiwi. And whoa, downtrend. All right, it was at the bottom of the heat map. Right, it was at the bottom, from the bottom to the top, and now we're here. It was at the bottom, and yep, Kiwi CAD's down there too. Aussie dollar's down there. We can take a look at Aussie dollar. And we can see that the heat map corresponds to what's going on in the market. So you don't have to go through all these charts. You can get a feel that, okay, the Aussie's weak. I've got this idea. Now, if it's an extreme, we can probably say, hey, maybe this will mean reversion. Maybe get a double bottom and maybe revert back to the upside like we saw dollar yen. But we have some ideas now. We can say, you know what? Maybe we're at a low. Maybe we revert back to the mean. We snap back up. But right now, no decision. We've got some other, the big drop has happened. So we can look for we have to use some other strategies to get us in the market. Okay, the heat map tells us where to look. Okay, so it's like being at the top of the building, and there's a great restaurant down there in New York somewhere, and you're at the top of the Empire State Building. Down in this area, there is a great restaurant right near Central Park. Okay, but you have to go down to your indicators and find out how to get there exactly. But the heat map will let you know which ones are trending and which ones are not. Okay, and so again, you can try that for 30 days as well for $1, and hopefully you guys are able to use some of this information. If you have any questions for me, I'll take. This is the end of the formal presentation on on avoiding choppy markets, but I'm going to go over those points, and hopefully we can get back up here. Okay. The internet is you're quite welcome, Rom. Did you that buy stop or sell stop on the euro? Were you was that useful? Did were you able to take that? That's a quick question. I'm curious. But we were talking about the choppy market. Oh yes. And do you mind sharing what you got? You got 10 pips on that. Nice, sweet. Okay, you're quite welcome. Yeah, he's an annual subscriber too. Well, Ron Prasad, we go way back. We were analysts on demand back in the day, and so that was he was Ron Prasad would get there in the morning and we would talk, and that was really cool. I said, Leonard, from my hometown, Marina Del Rey. He says, I miss Greg, which is a sentiment indicator. Not such a sentiment, it's volatility, the directional ADX. Now, that's a good thing you brought up, Leonard, because sometimes you can look at SSI and the sentiment indicator, speculative sentiment indicator, And usually if it's 2 or -2, that's the extremes, and so that we usually see pairs trending because people are on the wrong side of the market. When it's +2, that means we want to be sellers. If it's -2, we have more people short than long. Then we want to be long. Based on other factors. But if it's like is this 1 or 1.4? Well, that means people don't have a strong feeling, a strong sentiment about the currency pair or gold, or whatever. They don't feel anything about it. So if no one's feeling anything about it, no one's really interested in it, it's probably going to range too. So sentiment, that'd be my 6th way, Leonard. You're a genius. There you go. So we went from 4 ways to 5 ways to 6 ways. But always check your economic calendar, examine current price action, check for time of day, check www.myforexheatmap.com, and use your volatility indicators, okay, such as ADX, and also you can use your Bollinger Bands, and you can also use your moving averages, okay. So that's it for me. I want to thank you so much. Again, my name is Greg McLeod. See you on forexpaydays.com. See you in our free Forex chat room. If you're not part of that, you can talk with Holger, and he'll go ahead and get you signed up, and we'll see you soon. Have a great weekend, and we'll see you in our next webinar. Give me an email. Let me know what you want to see. If you have a question, if you contact me at greg@forexpaydays.com and say, hey, Greg, do a webinar on this. I did a special request webinar for Joyce, and I'll do one for you too. Thanks so much. Take care. Peace.